Welcome. In this clip we discuss the sources of demand for money, and we also look at the money market and the effect of different changes in the market on interest rate and the total amount of money in the economy. We start with the most obvious reason why people want to have money, and this is the transaction motive. Money, as we already know, is a medium of exchange, and it is required to facilitate transactions in the economy, for example, the buying or selling of goods and services. Let us assume for now that the economy produces upper scale Y amount of goods and services in 1 year. So this Y is roughly the same concept as real GDP. And we also know that 1 unit of this output, this GDP, will cost P. So this P is actually a price index. For example, GDP deflator or CPI. So then based on this, we can draw the conclusion that the total amount of money which is demanded in this economy to allow for all transactions to happen equals the nominal output or GDP, that is price index times real GDP, divided by the velocity of money, which is denoted here by V. The velocity of money can be defined as the number or volume of transactions that can be made by using 1 unit of money within a certain period, for example, within a year. Let us imagine a situation that someone lives in a less developed economy where money is rarely used. It is possible, for example, that people mostly do not use money, but they rather hoard money, but still once a year they have to make some transaction using money. So in this primitive economy, €1 worth of money would be able to facilitate only €1 worth of goods and service transactions. This means that the velocity of money is 1. This means that if in this economy you have €100 million nominal output, then you will need €100 million money in the economy. If, however, with economic development, people start to go to markets and use money more often, then the velocity of money starts to increase and actually less money will be required in the economy. The whole idea behind this transaction motive is also known as the quantity equation of money. So by just simply multiplying the previous equation by the velocity of money is going to give us the quantity equation. So the nominal GDP, or you can say the total value of goods and services in the economy, must be equal to the total amount of money times the velocity of money. If you make a further assumption, a very bold and unrealistic assumption, namely that the velocity of money is constant in an economy, then this will become the so-called quantity theory of money, which was the brainchild of a great economist, Irving Fisher. So far, we use the quantity theory of money. But in order to the quantity theory of money to be some kind of general theory of money, we had to assume that the velocity of money is constant. But this is not true. And this means that we have to find a way to expand our theory and introduce some alternative motives for the people to demand money. So, as for the constant velocity of money, we have to accept the fact that that is not true. Look at this graph, for example, which is from the Federal Reserve, that is, this data is for the United States. Now the blue line depicts the velocity of money, and as you can see, this is by far not constant. up to roughly 2008, you see an increase in the velocity of money, but after that it starts to decline. It is also visible on the graph that once you introduce some measure of the interest rate in the economy, then you can see a positive relationship between interest rate and the velocity of money. Namely, in periods when interest rate rose, you can also see that the velocity of money increased as well, and when the interest rate started to decrease, then there is also a visible decline in the velocity of money. So if there is a positive relationship between the velocity of money and interest rate, then this may actually give us a hint that somehow interest rates will also play a role in the demand for money. And the theory which is going to introduce interest rates into the demand for money is called the speculative motive. The explanation establishing a relationship between interest rates and money demand is also called the speculative motive or the liquidity preference theory. Now, while speculative has a negative connotation, in this case, it does not refer to some reckless behavior in the stock exchange betting about the rise or the fall of the price of certain stocks. Instead, it refers to a quite rational behavior of the agents. We define money as the most liquid financial assets, and by liquidity we meant the easiness of using these assets as a medium of exchange. So these assets were the currency and the demand deposits, and under normal circumstances these will not yield any interest. I said under normal circumstances because in countries with very high inflation it is possible that even demand deposits would yield a certain interest. But that is not a normal situation. So under normal situation, if you want any interest, then you have to use your money to buy some interest-bearing but less liquid assets, for example bonds and stocks. As a result, we can see that the higher the interest rate, the higher the opportunity cost of keeping money will be. So, in order to remain liquid, you have to give up some possible interest rate. There must be a negative relationship, therefore, between money demand and the interest rate. This explanation was proposed by John Maynard Keynes, the great British economist who is also often referred to as the father of macroeconomics. In his interpretation, interest rate is nothing else than the price of liquidity, and a few slides ago, if you remember, I interpreted interest rates as the price of investment. So these are then two compatible but still different interpretations of the same macroeconomic variable. On the right-hand side of this slide, you can also see a graphical depiction of the money demand, which already incorporates the speculative motive and the transaction motive altogether. In the depiction of the money market, we put the interest rate on the vertical axis and the quantity of money in the economy on the horizontal axis. And you can see that money demand will be a negatively sloped curve. And now we can look at the money market. In the money market, money demand is represented by a negatively sloped curve, while the money supply is a vertical line. The money supply could be understood as the total amount of available money created by the bank system. As a result, we can use our knowledge from the previous slide to say that money supply will depend on the base money, that is the money created by the central bank, including currencies and reserves, and the multiplier, which will depend on several behavioral factors. Now, if there is a change in either the monetary base or in the multiplier, then the money supply line can shift to the left or to the right. The money demand is negatively sloped and it incorporates both motives of the demand for money. It depends negatively on the interest rate due to the speculative motive, but it depends positively on the real income and the price level in the economy due to the transaction motive. Any change in either the price level or the real output would result in a shift of the money demand curve either to the right or to the left. So, to understand it better, let's just take some examples. For example, you can assume that the central bank increases the total base money in the economy. This could be done, for example, by buying stocks from the public. If you do this, then the total amount of money available in the economy will increase, so the money supply line will shift to the right. In this case, there will be more money in the market and the interest rate will fall accordingly. Another example could be that the prices go up in the economy due to inflation. If this happens, then the money demand will shift to the right, and with the unchanged money supply, this will mean that the total amount of money in the economy remains unchanged, but the interest rate will increase.